What if I told you there was a secret formula for investing? Like a real mathematical key that could tell you exactly how much of your money to risk on any single trade to maximize your wealth forever. Sounds like the holy grail of finance, right? Well, for a long, long time, a lot of very smart people thought it was real. So let's dive into that. And here it is. It's called the Kelly criterion. This thing was born at Bell Labs, and it's this elegant little formula that promises to give you mathematically perfect growth. Seriously, you just plug in your probability of winning, your probability of losing, your potential payout, and boom, it spits out the perfect fraction of your capital to bet. For serious traders, this was like being handed a secret weapon. But what if that perfect formula, this key to the kingdom, has a hidden, fatal flaw? A flaw so incredibly dangerous that if you follow it blindly, it doesn't lead you to a fortune. It leads you straight to ruin. And that gets us right to the heart of the matter. See, the math in the formula, it's not wrong. It's beautiful. The problem is the one giant, impossible thing it assumes. It assumes you can see the future. Okay, just look at this, because this is everything. The formula demands that you know P, the true, almost godlike, actual probability of your strategy succeeding. But in our world, in the real world, you never have that. All you have is P hat, which is just a fancy way of saying an estimate. It's a guess based on whatever data you have. And that tiny little gap between perfect knowledge and an educated guess, well, that's where the disaster happens. This is what academics call estimation risk. So why is just using your best guess so dangerous? Well, it creates a nasty chain reaction. First, if you get a few early wins, you fall for overconfidence bias. You start treating your guess like it's a fact. Second, that overconfidence leads you to bet way too big, way too early. When your luck inevitably cools off, those huge bets can wipe you out. And finally, the market itself is always changing. Your winning streak might have just been a fluke of the market conditions, and the classic formula has absolutely no way to adapt when things shift under your feet. So, if the classic way is just too risky, what's the answer? Well, you can't just wish uncertainty away. But what you can do is build a system that actually respects it and even better adapts to it. And the solution, according to this really fascinating research by Sergei Sukov, is to just stop pretending we have all the answers. It's about building a system that starts with humility, that learns from new evidence, and that embraces the simple fact that we're always working with incomplete information. It's called a Bayesian approach, and it's actually incredibly intuitive. Here's how it works. Step 1, you start with a totally neutral belief. You just assume your new strategy is no better than a coin flip. Then, you start collecting real data from your actual trades. And with every single result, win or lose, you update your belief. If you keep winning, your confidence grows. If you start losing, it shrinks. And here's the magic. Your bet size automatically adjusts based on that level of confidence. You're not guessing anymore, you're learning. Okay, that sounds really smart in theory, right? But does it actually work in practice? Let's get to the fun part. Let's look at the data and see how this smarter approach stacks up against the old school methods in a head-to-head showdown. All right, check out these simulation results from 10,000 different runs. Full Kelly, the classic formula, had absolutely explosive growth. But look at the cost. A gut-wrenching 62% maximum drawdown and nearly a 1 in 5 chance of going completely broke. Insane. Half Kelly is much safer, but you give up a ton of growth. But now, look at the Bayesian Kelly. It actually captures more growth than half Kelly, but it cuts the drawdown to just 25% and practically eliminates the risk of ruin. That is the definition of a smarter risk. Now, simulations are great, but, they're clean. They're theoretical. The real question, the one every investor should ask is, does this actually work in the messy, chaotic real world? And this is where it gets really compelling. The researcher ran these exact same strategies on 19 years of real S&P 500 futures data. Everybody got the same trading signals. The only thing that was different was how they decided how much to bet. Let's break down what happened. Okay, I want you to focus on panel 2 here, the drawdown chart. See that terrifying dashed red line? That's the full Kelly strategy. In the early 2000s, it got a few wins, got way too confident, and overbet itself into an 88% drawdown. It essentially blew up the account right out of the gate. This is the exact danger we were talking about, but playing out in real life. Now let's look at panel 3. This shows how big their bets were over time. The red line, full Kelly, is swinging for the fences from day one. But look at the green line. That's our Bayesian Kelly. It starts with these tiny, almost insignificant, cautious bets. It only starts to risk real capital after years of data have built up its confidence that the strategy actually works. And that cautious start? Well, that's the whole secret. It's right here in this quote from the author. By just avoiding that massive early loss that absolutely crippled the full Kelly strategy, the Bayesian method protected its capital. It set itself up to win in the long run by simply not losing big in the short run. So, when all the dust settled, who was the undisputed champion? This chart shows something called the Kalmar ratio. It's just a way to measure how much return you got for the amount of risk you took. Full Kelly is negative, a total failure. Half Kelly is pretty good. But look at Bayesian Kelly. It's in a league of its own, delivering way more reward for the risk you had to stomach. It's the clear winner. So what does all this mean for you? Well, this is more than just some cool theory. It's a practical playbook for managing risk in a much smarter way. Let's boil it all down into some simple rules you can actually put into practice. Okay, here are 3 rules for much more robust sizing. First, start humble. Assume any new strategy is basically a coin flip until you have a mountain of evidence that says otherwise. Second, use a safety brake. Don't just double your bet size after a couple wins. Ramp up your risk slowly, deliberately. And third, and this is maybe the most important, set a hard limit. Never, ever let any formula convince you to risk a catastrophic amount of your capital. Pick a number, say 25%, and just never cross that line, period. So this really all comes down to one final crucial question you have to ask yourself. The classic Kelly formula, it sizes your bets based on the hope that your estimate is correct. The Bayesian approach, on the other hand, waits for proof. So take a look at your own process. Are you sizing your positions based on hope, or are you sizing them based on evidence?